So in the third and final video on the series on natural resources, that's agricultural, farmland and timberland, as well as commodities, it's time to look at their risk and return profile, as well as, very importantly, how they fit into a diversified portfolio and what diversification potentially benefits they bring. Okay, let's start off with commodities. In terms of the interplay between supply and demand and what effectively drives the price of commodities, we'll start off with the supply side of the equation. The supply of commodities is determined by production amounts. For example, how much coal or oil or metal gets extracted from the ground. So this is for hard commodities, simply. And for agricultural produce, it's crop yields. So that's going to be the case with soft commodities. Now, in the short term, we're going to be focusing on inventory levels as the driver of supply, but also thinking about the actions, not just of the producers, but of non-hedging investors. Those are investors who go into the commodities market for speculative purposes, as opposed to purposes associated with protecting from swings in price, which would naturally offset what they are exposed to in a business sense. In terms of the demand side of the equation, demand is pretty much determined by the use of consumers and end users. Consumer and end user needs or uses, but also, of course, once again, the actions of those speculative or non-hedging investors. The influence of those investors can both, let's write this down. The investors can either increase or actually dampen fluctuations or price volatility. We typically think that they increase price volatility, but sometimes they play the opposite role. So it's not necessarily one-sided in this case. Right. The important thing some important points to take away, especially in when it comes to the supply side of this equation, is that with commodities it's going to be difficult for producers to quickly increase supply. Supply quickly. For agricultural products, you're going to need at least one production cycle, one growing cycle, to bring more crops to the market. Obviously, for hard commodities, mineral resources, metals, energy, you're going to sometimes need years for production facilities, for mines to be established, drilling facilities to be established. And of course, there is that with agriculture, also that problem of weather, which can pretty much ruin all plans to increase supply, because weather can have a huge impact on crops and crop yields. So what's the rationale for commodities investing? Well, three things: returns. Commodities are shown to outperform stocks in the long term. Commodities outperform stocks over the long term, but this comes at the expense of significantly higher volatility, but with at significantly higher volatility. Okay. Then there is the aspect of portfolio diversification, which we'll talk about in a couple of minutes, and inflation protection, which I'll also talk about in a moment. Once we discuss a few ideas, a few concepts concerning the returns associated with farmland. So let us now write down farmland and actually timberland as well. Farmland and timberland. Here, let's say that these two are less frequently traded. We've got less information about their prices than we do with commodities. And let's also say that there are different sources of value here. When it comes to farmland, the returns are generated over multiple growing seasons or growing cycles, and your curriculum also notes that circa around about less than 5% of farmland is actually held by institutional investors. In the case of timberland, the growth cycle for a forest is much longer than it is for crops. So forest growth cycle is longer than for crops. Definitely. So instead of having multiple growing seasons and cycles within the investment horizon, you may have just one, for example. And around 25% of all timberland is, at least that's what your curriculum states, is held by institutional investors, so that's a much bigger involvement. Now, farmland historically has higher returns. Historically higher returns, but it has very low liquidity. And of course there is that also big initial cash flow outlay associated with the purchase of the land, but also later on, with having to maintain the land, there is a high cost. So this is initially a big negative outlay plus initial cost of maintenance. the high cost of maintaining the land once it has already been purchased, and whatever you've got crops are growing on it. There is fertilizer costs, seed costs, obviously making sure there is water supplied. All of these are pretty much fixed costs, and of course the price is very variable, so you have no guarantee of actually covering that cost. So with those fixed costs, we've got plus with variable revenue, where the price of your crops may go up and down depending on primarily weather patterns. And this dependence on weather is going to be a unique risk factor for farmland, but also for timberland, I guess, or maybe not to the same extent. It's not found elsewhere in other types of investment. Definitely not in classic real estate or just purchasing, raw land, which may be turned into anything. Good. Both farmland and timberland are exposed to very similar global risks. Because commodities like crops are traded globally, anything that happens around the world may affect that global price of stocks, which is of commodities, which is of crops that are produced from farmland, or timber that is produced for timberland, and that may affect the viability and the returns generated anywhere around the world. Disruptions in world trade, like we saw during COVID, will also have a huge impact on rates of return. Now, I guess most importantly, we have to explore how these two contribute towards inflation hedging a portfolio and what diversification benefits they may bring. I mean, most of the stuff so far, I guess, has been pretty straightforward. Even if you were to get a question without doing any studies, you probably would know the answer. Right. Let's focus on the inflation hedge aspect, or the inflation hedge claimed benefit. Commodities first. Commodity prices are part of inflation index computation. We said that before in a previous video. Commodity prices are absolutely part of inflation index computation. So, the prices of food, the prices of energy are one of the most important components of any sort of CPI index. But at the same time, commodity prices are not the only components of those indices. There are other things like house prices, rents, the prices of services, and lots of other stuff. So commodity prices are themselves more volatile than inflation, which is an average of different price computations from different goods and services. Inflation has more components. Inflation indexes have more components than just food and energy. So therefore, the inflation computation is less volatile than the price of commodities or food or energy as such. But having said this, you should know that there is evidence which your curriculum references which shows that commodities do indeed perform well when inflation is up, and definitely they perform poorly, worse, when inflation is falling. So yes, there is that inflation hedge aspect to investing in commodities. There is definitely less evidence to suggest that farmland and timberland perform similar in a similar way, to suggest that farmland and timberland perform differently in different inflation environments. So this is something your book goes into quite a lot. They kind of hammer this point quite a lot, and the takeaway should be, in terms of being an inflation hedge, commodities, yes. Commodities are a better inflation hedge, definitely, than farmland and timberland. Farmland and timberland, not necessarily a good inflation hedge. And you may easily be asked a question on this. Theoretically, out of the two, the two natural resources, they will not necessarily mix different things like, natural resources versus real estate versus other stuff, because they come from different readings in the curriculum, different learning modules. But within a certain learning module, making that comparison, you should be able to do that. Now, the second aspect of all this is the portfolio diversification benefits of holding either commodities or farmland and timberland. So portfolio diversification. Good. Okay, here. All three, so commodities, farmland, timberland, all three have low levels of correlation with returns from traditional asset classes. Now, when it comes to the correlation with bonds, at least over the long term, close to 0%, well, not 0%, sorry, zero correlation. Correlation is not measured in units with the performance of bonds, as we would expect. Now, what about global stocks? Once again, over the long term, with global stocks, there is going to be a difference. The lowest correlation with global stocks is exhibited by timberland. Timberland, your curriculum claims, has the lowest correlation with global stocks. Correlation, close to 0. So just like with I guess with bonds. Farmland comes next. It has low, but not the lowest level of correlation. And then the highest of these is exhibited by commodities. Commodities have the highest. It's still, it still provides some diversification because your book says the correlation coefficient is about 0.41 over the long term. At least that's what certain studies have shown. But you can guess why. Commodities are heavily commodity indices are heavily dominated by things like oil and gas, energy related commodities. And those are going to be hugely impacted, or their price is going to be hugely impacted by global business cycles, global demand and supply, which is linked to performance of the economy globally as a whole, which is also reflected in stocks. So if you're looking for inflation hedges or an inflation hedge, then definitely commodities are going to be better than timberland and farmland. However, in terms of portfolio diversification, you really can't beat timberland and farmland with commodities. Make sure you know that. Very easy to imagine a theoretical question on that aspect.